Well, to be honest, I think pretty much everything hinges on trade developments and the negotiations between the US and China. I think it's fair to say that we went initially through a phase in October where there was some market euphoria back then. We saw risk assets rallying. We saw a very, very bad month for the dollar, actually down 2% on a trade-weighted basis. Now, as we moved into November, now obviously markets started getting a bit more anxious because we were not really getting the decisive headlines that we would like to. But the view here is that we're making incremental steps towards a phase one deal. I think it's fair to say it's going to be a limited deal in scope, in terms that it's not going to cover various aspects, and I suspect it's going to have very little on intellectual property rights. But I think to the extent that we're going to get a phase one deal, potentially by the end of the year, I think the market is going to perceive that as a good sign. Let me say the following. I mean, we went through a really rough period since mid of 2018, and there were two things that they were working pretty much in parallel. First of all, there was the actual effect of the trades, of the world trade being clogged because of the tariffs. But the other one, the second one, which to a certain extent you can actually say that in various points has been more important, was market sentiment, investor sentiment, business sentiment. Now, if businesses' investments start seeing some sort of progress, I think this issue with the sentiment is going to start getting improved, and you're probably going to see some risk normalizing.
Vasileios, very good morning to you, my friend. If we do get a trade deal and if the market rallies on the back of it and if things are perceived to be safer and less volatile around the world, does that mean the central banks have less pressure to act, and as such we lose one of the other potential props for the market?
Well, Steve, you know, it's one of these things. You always have to counterbalance. You have the negatives, you have the risks, and you have the positives, the stimulus. But the stimulus has to be there for a reason whenever there is the offsetting force because of the negative reasons. I think that's true. I think what you're saying is absolutely true in the sense that, yes, first of all, monetary policy, with the exception of the US and potentially in emerging markets, but other major central banks like the ECB, you know, the BOJ have pretty much come to a point where they cannot really do anything more meaningful from here, whether there is an escalation or whether there is a de-escalation in trade tensions. So I think to the extent that we're going to get some normalization and a modest pickup in trade, which is going to start filtering through into growth, yes, eventually the need to provide more stimulus from the monetary policy channel is going to be less.
You have a very large thematic piece out, which Karen and I have both been pouring through, which is Outlook 2020. And you're asking the big question. I don't know what the answer is, though, so you're going to tell us now. The question is the dollar heading for a secular decline? To which the answer is...
That's right. We think it is. We think it is. And I'll tell you basically the way I see things over the past 1.5 years. Basically, we need to separate how the dollar has actually moved over the past 1.5 years. The main appreciation in the dollar came from April 2018 to November 2018. That was the big rally in the dollar, and since then it has been going up and down, but it hasn't really done much. On a year-to-date basis, it's simply up 0.5%. And what happened there was not because the Fed was actually hiking rates, because the Fed was hiking rates in 2017, and still the dollar was actually falling off a cliff. What happened is that you had the uncertainty because of trade, sentiment deteriorated, and at the same time, you had the US economy being cushioned by the late cycle stimulus. But now, if you get the uncertainty slightly better, you have a dollar which is overvalued, and at the same time you don't have the fiscal impulses there in the US because they are pretty much fading, then that implies that you're more likely to start moving in a more fundamentally aligned territory, which means that the dollar, the overvalued dollar, should actually start converging lower.
Vasileios, a natural question then, what benefits versus the dollar could it be the euro at this point?
Well, okay, let me say the following. First of all, in terms of our forecasts going 1 year out, I think we have it at 115. So it's a relatively modest appreciation from here because there is no question that the Eurozone still faces a number of headwinds, especially those that are coming from Germany. But at the same time, let me say what really matters for Eurozone's experts and how it is really being affected by the currency is actually the trade-weighted euro, which basically is used as a proxy for all the various trades that the Eurozone is doing for the rest of the world. Now, to the extent that the trade-weighted euro appreciates but is held in check, as we pretty much expect, there isn't going to be so much of an impact. And let's not forget that because of the value chains, there is a lot of empirical and academic evidence over the past 4 or 5 years that the pass-through from FX to the actual economy has been very much limited than we thought 10 or 15 years ago.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.